why don't we talk about what the overall investment over 30 years looks like?
I love that idea. Yeah. Okay. So, well, what do you know? Those numbers appeared. So, as a part of being a JWB client, you not only just get to think about the transaction today, you have a plan that's built for you. And because we have 18 years of experience of owning rental properties ourselves and own over 400 rental properties and have, managed over 3,000 rental properties for our turnkey clients. We manage over 6,000 properties right now. We know how these things are going to play out over time, and you can start to model your plan. And so what I do is I use that same modeling tool to model out one property that's purchased today with today's purchase prices, today's interest rates, today's financing. Mm-hmm. And I say, over 30 years, how much are you actually going to earn from your different profit centers? And there are 5 profit centers. I only put 4 on here. The 5th one is
inflation hedging.
Yeah, it's inflation hedging, and it's a little bit more complex to throw into an evaluation. And the reality is, you can see the profitability there. It's quite large. So we don't necessarily need it to prove the point. So you've got your 4 profit centers here, 4 of the 5. Number 1 is net rental income. Number 2 is tax savings. Number 3 is principal pay down. Number 4 is home price appreciation. Put all these numbers, I'm sure we're going to go over these numbers right here, but your total pie here is large. It's large here. The total profits earned here is almost $1 million over a 30-year hold for just one rental property.
Yeah, that makes sense. And you see, you put in here, I'll go over for anybody listening on the podcast, total profit 30-year hold is $193,000 in net rental income, about almost $19,000 in tax saving, $144,000 in principal pay down, and $633,000 in home price appreciation. As we always talk about, home price appreciation ends up being the biggest part of the pie. When you look at it, do you see I'm doing a little bit of reverse financial engineering here myself? $144,000 in principal pay down. Does that mean we're looking at about like a $200,000 house?
Yeah, $240,000 house. It's actually there in the fine print at the bottom there. I used a $240,000 purchase price. It appreciates, home price appreciation estimated to be 4.8% per year. The actual home price appreciation for Jacksonville is 5% a year, going back since 1982. So went a little bit conservative there. We're assuming you purchase it with 40% down on a 30-year fixed rate mortgage with an interest rate of 6.375%.
Got it. So we were looking earlier at the total profit of a 30-year hold for a $240,000 home. Total profits earned is $989,391 over 30 years. Now, we said we were going to talk about breaking up into different time buckets. Mm-hmm. I see that you chose 10 years. Is there a reason why you chose 10 and 10 and 10?
Not necessarily. I could have chosen 5 years or 10 years or 15 years. I think, many people in their head, I don't know, I'm maybe generalizing, but many people are thinking, wow, I can't think about holding something for longer than 10 years. I can't think about holding a piece of property for longer than 10 years. For some reason, that is a mental hurdle for people. So that's why I chose 10 years, which is interesting to me, though, because if you think about how they invest with their retirement accounts and the things that they do with those retirement accounts, you ask them how long they're going to invest there.
I don't even know. 40 years, 50 years? Yeah.
I don't know. 100 years. I'm going to live forever. I'm going to invest there forever. Yeah. But for real estate, for some reason, they think, it's hard to get past that 10-year threshold.
Okay, so let's not get past the 10-year threshold. Let's talk about the 10-year threshold.
So not every one of these decades is equal here in terms of profitability. So years 1 through 10, your profitability is going to be different than other years. So out of this, call it $1 million pie of profitability that you're earning over 30 years, roughly $130,000 is earned in years 1 through 10. That's not equal to a third of that, right? No. So while this is really strong and your returns on investment are 10% or something along those lines right there, this is the least profitable trimester of the 30-year period. I don't know if that plays, right? But it's the least profitable decade, right? Which you can kind of see where I'm going. The longer you hold here, you're going to see more and more profitability.
All right, right on. So then years 1 through 10, your net rental income is $5,859. Tax savings, $2,665. Principal pay down, $22,308. And still the champion of the world here, home price appreciation is $96,597 for a total of $127,429 of that total, which is 989,391, let's look at years 11 through 20. What do you think?
All right, so we're starting to make some serious headway here. Years 11 through 20, you are starting to see some significant gains in net rental income, as well as principal pay down, and of course, home price appreciation. And, I went in a different order here, but as well as tax savings. So let's kind of go through each one of these and talk about why this is gaining so much more in years 11 through 20 than years 1 through 10. I'm going to put you on the hot spot a little bit. All
Okay,
right.
cool.
The hot seat. So net rental income, years 1 through 10, you only earned about $6,000. Years 11 through 20, you're earning $56,000.
It's 11 times that.
Yeah. Why is that happening?
Because rent prices go up year over year while your mortgage stays the same.
Exactly. That cash flow spread grows year over year over year over year over year. It's growing in years 1 through 10 because you bought the property with break-even cash flow. I mean, at the end of 10 years, you had $6,000 of positive cash flow from net rental income. But that margin just widens in your favor for years 11 through 20 to the tune of, $56,000, right? That's while you earn $6,000 in, years 1 through 10, you earn 10, 11 times that in years 11 through 20.
Got it. Okay. Any other quizzes for me? Any other brain busters?
I don't know. Let's see what else we got. So tax savings, the longer you hold on, right? What we haven't shown a lot of light on in the show is for tax savings, right? You get to write off against the income, the rental income that you earn. Well, when you have less rental income in years 1 through 10, you don't get to use the full effect of all of your tax write-offs until your rental income is so high that it outpaces the amount of the write-off from depreciation on the tax savings. So that's the real reason why tax savings grows so much more in years 1 through 10 to years 11 through 20. It's because it's a factor of how much income you're earning now, and then you can maximize the full deduction that you get from depreciation, which is the tax savings component we're talking about.
Interesting. All right, let's get into years 21 through 30, shall we?
I love it. So we talked about the huge increase in years 1 through 10 for net rental income until years 11 through 20. But Pops, look at years 21 through 30. How much net rental income are you earning?
$131,566.
$31,000.
Yeah, that's amazing.
Over 10 years, $13,000 a year you're earning in net rental income.
That's a lot of money.
And this is even before your mortgage is paid off. This still has a mortgage payment there. If I ran it out to years 31 through 40, it'd be even more eye-opening as far as the amount of net rental income that you're earning simply by buying this asset and letting it do its thing and holding on.
Yeah. And listen, if you're watching on the podcast, skipped on the year 11 through 20 numbers, but what we are seeing across the board is growing numbers in all the buckets, right? So net rental income went from like 5,000 to 55,000 to 131,000. If we're going to keep it real simple, principal pay down went from 22,000 to 42,000 to 79,000. Why does that happen, GC? Why does principal pay down go up? We haven't talked about that.
Yeah, I'm glad you asked. So in your loan that you may have with the home that you own or that you own out there, what you'll notice is that your payment every single month to the bank probably is the same if you have a fixed rate mortgage, fixed rate loan. But if you look, the amount of principal that you pay down every single month actually grows. So that's what an amortized mortgage is. It means that in the beginning, you're paying almost everything in interest out of that set payment that you make every single month. And over time, each and every single month, you actually start to see that switch a little bit. And it's slow in the beginning. You start to see every month you're paying more principal down, less interest. Next month, more principal, less interest. And it really adds up over time. And so the way that an amortized mortgage is created is that you're paying the bulk of what your loan payback is in the last third of ownership. And so in other sense, another way of saying this is the most advantageous time for your principal pay down profit center is years 21 through 30. And that's what you're giving up by selling this asset so early.
Yeah, you're giving up on building that equity that whole time, right?
Exactly.
Love that. And then home price appreciation, of course, continues to be the rocket ship, the rocket fuel for all of this thing, 329,000, going from 96 to 206 to 329. And then if we look across the bottom line, right, these like total profits earned over the life of the investment are 989,000. Years 1 through 10 are 127,000. Years 11 through 20 are 313,000. And years 21 to 30 are 548,890. So what you're looking at is essentially total ROI wise, total return wise, you're getting about 1/8 of it years 1 through 10, 1/3 of it years 11 through 20, and almost 2/3 of it in years 21 to 30.
Exactly. Over 50% of the profitability of the asset is in the last decade of ownership, the last third here. And that's what you're giving up. And I would love to hear from the audience if this is new news, have you ever seen it portrayed this way? Because this is real. This is why I own those 400 rental properties. I've owned them for 18 years now. I mean, it's because I see the value of holding on, and I'm able to deal with any type of, bumps that come along the way in terms of maintenance issues or vacancy issues. It's because I got my eye on the prize. I'm looking at years 21 through 30.
Yeah, I think it's interesting that you, as an experienced investor that has lived this, understand this, right? Like, we are showing you the return here of what happens as time goes on. But since you've lived this, you also know that the number one reason you don't get here is because of bumps on the road, right? So you've built a business around smoothing the bumps, right? So like, there's going to be bumps, but you don't really have to deal with them.
Right.
You just got to like psychologically be prepared every once in a while to lay out a little bit of cash into the investment so that it continues performing like it does, but you don't have to do any of the actual work outside of take a couple phone calls here and there, a couple times a month, maybe. And that to me is like the value of it, right? If we can smooth out the ride and make it obvious why you want to be it for a long term, that's why you are putting these dots together.
Absolutely. And that's why we talk about the priorities. If you're a new investor, the priorities that you should go about when making the decision is, number one, the team, because the team is going to actually create the returns on investment for you. But more importantly, the team is going to be in control of the experience for you, because it doesn't matter how much money you make. If you have a poor experience, you're not going to last. Right. So the team has to be the number one and most important thing that you need to do your due diligence on and make your decision based on. Next would be the market, right? The reason why these numbers are really strong is because of the strength of the Jacksonville real estate market. These numbers are stronger because of Jacksonville than if I was doing a similar exercise for other cities that don't have as much rent price growth and home price growth. So next, your number two decision-making factor is the strength of the real estate market, the market. And then your third and final part of the decision, and the most fun and enjoyable and easiest part of the decision, should be the asset, should be the property. If you've done the job well and focused on the team first and then the market second, that team in that market will be able to provide a great asset for you. It should be fun and enjoyable to make a great decision on the property.
Yeah, there you go. So if these numbers make sense to you, you want to get in, you want the team, you want that smoother ride, chat with jwb.com and start talking about how this fits for you based on your financial situation, based on your life situation and what you got going on.